Hello, everyone. Welcome to our webinar today. Thank you for joining us. My name is Carrie Minnick, and I'm the partner here at DWD in charge of our nonprofit team. Also joining us today is Susan Berghoff, the director, and also Tyson Moore, supervisor. As Tyson leads us through this session today, we encourage you to submit any questions or comments that you may have in the Q&A or chat window. Susan and I will be behind the scenes addressing those. A copy of the webinar, the slides will be emailed out to you after the webinar. In addition, a recording will be available on our website along with all of our other prior webinars that we've had, so you can access those there. There will be a link at the end of the session directing you towards that. So at this point, again, thank you for joining us, and I will turn it over to Tyson.
Thank you, Carrie. Good afternoon to everybody, and thanks for attending today's webinar titled Debunking Nonprofit Myths. Today's webinar is meant to be interactive, so we're going to answer questions throughout the presentation as well as at the end if time permits. So I'd like to start out by having you put any nonprofit myths that you've heard into the chat. So anything that you heard that's obviously false or maybe you're not quite sure about, you want us to answer, either way, put your myths in the chat, and if we have time towards the end of the presentation, I'll address your myths and any of the myths that we haven't covered during the webinar today. Let's start with our first myth, which is nonprofits are not important to the economy. So this really couldn't be farther from the truth. There's 1.6 million not-for-profit organizations in the US alone. Not-for-profits generate $390 billion in charitable giving every year and employ 12.3 million people. It makes up about 10% of the total workforce. Nonprofits are also the third largest sector of the economy, behind only manufacturing and retail. Not-for-profits generate more than just money as well. So they generate 63 million in volunteer hours, which generates about $193 billion in donated time. They also drive local economies. They consume goods and services and create local jobs that have a far-reaching impact. Locally, we can think about not-for-profits like, let's say, the Fort Wayne Civic Theater. So let's say you attend one of their plays. When you go to the play, you don't just support their local crew and their admin staff, but you probably also paid for parking, which created a job for a service attendant or their admin staff. You probably bought new clothing or shoes to go to the show, helps support local retail jobs. You might have also went out to dinner before or after the show. That supports the local service industry. So this is the extended impact that local not-for-profits have. It often goes unnoticed and undocumented. It's kind of hard to put your finger on. So a lot of time it goes unnoticed. Not-for-profits also cultivate and train local leaders, not only through the jobs they provide to the local community, but through various board and committee opportunities. There's hundreds of people in Fort Wayne that probably didn't learn leadership at IPFW or Indiana Tech, but by joining the board or committee of our local not-for-profits. As part of these boards and committees, they are going to do things like help organize events, recruit other members to the board, or learn to work as part of a larger team, and many other soft skills that they probably didn't get a chance to learn in college. I'd like to think that's kind of how it worked for me personally. So I started my career as an accountant at the United Way of Allen County, right out of college as a staff accountant. In my first year, we had an event that was called Power of the Purse. This was a fancy event where we auctioned off high-end designer handbags. My task was to find the best software to take payments and develop a process for checkout once the auctions were closed during the night of the event. So I had the opportunity to do things like research different software packages. I contacted local not-for-profits that run similar events to see what software they'd used and how their checkout process was ran. I trained 7 people at United Way to use the new software and how the checkout process was going to work the night of the event. Remember, this is all in my first year right out of college. I really didn't know what I was doing and kind of thrown into the fire. But I think it really helped me personally. As an accountant, I don't think this would be something I'd really get a chance to do at a bigger for-profit company, let's say Sweetwater or one of our other local for-profit organizations. And I think this is a big part of what local not-for-profits provide to the communities that they operate in. Myth 2 is that the best nonprofits have the lowest overhead rate. So this is probably the myth I think I've heard the most while working with local not-for-profits. Do any of these things sound familiar? So no administrative fees means that all the money goes to local charities. Our organization has remained lean, allocating nearly 90% of revenue to direct service programs. 100% of your donation will go towards programs that help children, and 0% will go to overhead. So I've personally been in board meetings where people have said that money spent on overhead means less people are being served, and low overhead is a sign of an effective organization. So while some of these lines are true, partially, it's apparent that most people aren't aware of costs involved to run a not-for-profit. Specifically, donors and even board members oftentimes put too much emphasis on overhead costs and not enough focus on the impact that the organization is making. So we've talked a lot about overhead here. What exactly is overhead? So overhead is when you combine your management and general costs with your fundraising costs. And oftentimes you'll see this as an overhead cost percentage. So to calculate this percentage, you combine your management and general costs with your fundraising costs and divide it by your total expenses. This constant focus on driving down your overhead costs often starts what is known as the starvation cycle. Let's take a moment to talk about the starvation cycle here. The starvation cycle starts with unrealistic fundraiser expectations, which eventually puts pressure on a not-for-profit to conform, which ultimately can lead to things like misreporting your overhead costs or just simply underfunding overhead altogether. So let's start with the funder expectations. Generally, funders don't really know the costs needed to keep a not-for-profit running. These are things like your building costs, HR and accounting fees, your insurance costs, general supplies, and many other general expenses that you need just to keep your organization running. And this starts the cycle of pushing down overhead costs over time and essentially starving the organization from the inside out. These expectations put pressure on not-for-profits to conform. The result of this pressure comes in two forms, which is underfunding your overhead or misleading reporting of your actual overhead costs. We'll start by talking about underfunding your overhead and what that can do to your organization. When you underfund overhead, you typically reduce things like, let's say, staff training is a big one. And this can lead to underperforming or unhappy staff members. It also can increase your turnover numbers. It also can make it difficult internally to build a senior team from within, as these lower level employees don't get trained enough to move up within the organization to a senior staff level. Underfunding of overhead can also create things like issues with technology. Having lower quality technology internally could mean that you have lower staff production due to technology issues, or maybe production stopping altogether if you have computer failures during the year. Another big risk here is data loss. So if you have an older server, what can happen is you could lose a lot of your data if that server goes down and it's not backed up properly. And for some organizations, that can be a really big deal. Also, underfunding overhead can mean inadequate facilities, as you don't put more money back into your facilities, and this could have far-reaching impact in your organization as well. This could mean that you don't have routine board meetings on site, or it's very hard to do so. Could mean that you have to rent out extra space for those meetings. It could even make hiring potential employees a little bit harder as you go through the interview process, and an employee walks through your organization. They may not see it as a desirable place to work. In a recent not-for-profit study of directors found that 50% of them plan to reduce overhead costs within the next year. So if this is something that your organization focuses too much on, I'd suggest evaluating that thought process. Be sure you know the potential long-term effects of lowering your overhead. So the other effect that we have here is that you could lead to misleading of reporting your costs. So this was generally going to be underreporting your fundraising and your management and general costs. So a recent Indiana University study of 990 costs found what they called widespread reporting that defies plausibility. That's their terminology, not mine, but they looked at 220,000 990s. And researchers found that 1/3 of the organizations reported no fundraising costs at all, while 1 in 8 reported no management and general expenses. So let's think about this for a second. So some of these organizations have hundreds of thousands of dollars in contributions and no fundraising costs. I'm sure if there's some fundraising people on the webinar today, they're wondering where this money came from. Sadly, the answer isn't that money grows on trees. It's that probably the fundraising costs here were underreported, as well as management and general costs. So if there's a lot of organizations underreporting these numbers, let's talk about what should be a part of programming, management, general, and fundraising costs. These are the 3 buckets you'll find on your 990. So we'll start with programming. These are all expenses related to providing your organization's program and social services. This could be a portion of salary spent on running your program, supplies used to facilitate your programs, and many other costs related to running your specific programming. So what should be considered management and general costs? Well, these are things like accounting, your general liability insurance, legal services, your HR costs, any board of director meeting costs, other general staff meeting costs, and if you have investments, any costs related to managing those investments. So what should be considered fundraising? Well, in most cases, part of the organization's top official salary should probably be allocated to fundraising costs, some mailing or office supplies that are related to fundraising, cost to advertise if the main purpose is to ask for funding, and costs related to your fundraising events. So these can be things like rentals for the event, food, a DJ or an MC for your event, and any print and copy fees. These can be things like invitations or promotional flyers. So some costs should also be allocated across all 3 buckets. And there's really only one general rule here, and that they must be allocated on a reasonable and consistent basis. So a basis is a way to allocate your costs and should be based on what drives the cost. For instance, a good way to allocate rent is based on square footage. It's reasonable to assume that if you use 50% of, let's say, your building space for programming and programming services, that 50% of the rent should be allocated to program. Other items that should be allocated are your salaries. They should be allocated based on the time spent of each individual. Depreciation is often allocated, a lot of times in the same way that your building costs are allocated. IT costs can be allocated, and website costs, many other costs can also be allocated, but know that these allocations need to be reasonable and have a consistent basis. One thing to remember about allocating costs, organizations are always changing. So what may be a great way to allocate a certain cost last year may not be the best way to allocate a cost this year or 2 years from now. So make sure that you review these allocations every year to assure they're accurate. If you have an audit done, hopefully your auditor is reviewing these with you every year. If you haven't looked into expense allocations recently, this may be something you want to discuss with your auditor or outside accountant. So here's a good historical chart of overhead costs over time. It shows overhead percentages historically for all not-for-profits. As you can see, it's consistently been going down since around the 80s, late 80s. This was an era that started increased focus on not-for-profit operations. So why was there this heightened awareness of overhead around this time? Well, back in the late 80s and 90s, there were many not-for-profit scandals kind of happening all at once. Most notably was William Aramoni. He was the CEO of United Way Worldwide. and stepped down after embezzling $1.2 million in donor funds. There was similar damage done by the CEO of New Era Philanthropy from 89 to about 1995. If you don't know about New Era, I suggest you look into this one. It's kind of interesting. It was a Ponzi scheme that involved religious organizations. If you have a little bit extra time, read up on that one. But just know there's some decent amount of scandals happening around this time. Around the same time, charity watchdogs such as GuideStar, Charity Navigator were starting to emerge. And they started to rate organizations based on their overhead percentage and publish these figures for potential donors to look at. So I know if you look at this chart, it ends in 2005. So the data is a little bit old, but it's kind of meant to look historically at what's happened. But I did look up more recent numbers through the year 2020. Overhead costs have gone up from 05 to 2020, just slightly. They're still under 20%. So this is still an issue that we're currently dealing with. And so what should your overhead costs be? Well, the Better Business Bureau likes to see around 35% as like a maximum overhead rate. So, and 65% allocated to programming. While the United Way of Allen County likes to see a maximum of about 25% in your overhead rate. Okay, so now you know about the starvation cycle and the overhead issues, but how do we change the cycle? Well, I think the best way to do this is through board and donor education. A recent study of donors and board members found that most people surveyed considered overhead to be more important than program effectiveness. I'm just going to say this one more time. So most people surveyed considered overhead rate to be more important than program effectiveness. This is crazy to me. So to put it another way, people would rather see you reduce your costs than to see you run an effective program. This is a major problem and affects many not-for-profits and can be changed with how you present information to key members of your organization. So organizations must attempt to educate their donors. Obviously, donors don't want to pay for your organization's rent or phone bill or stamps, but they need to know that these are essential to running your programs. You obviously can't run an organization from your car, and there are many ways to better present this type of expenses to your donors. The best way to change the thinking is to focus more on client impacts and less on how far you're going to drive your overhead costs down. One step is to develop a strategy that recognizes infrastructure needs, framing discussions around strategy through a clear plan that lays out your organization's goals, the investment needed to achieve the goals, and resulting benefits for the clients can be more useful than centering the entire discussion around costs. Even within the confines of a cost conversation, you can use this type of plan to illustrate how infrastructure investments reduce the cost to serve your clients over time. Nonprofit leaders can further increase their ability to invest appropriately if they communicate the logic for increased overhead investment throughout the internal organization and to the board of directors. A collective commitment from all levels of the organization, including your senior staff, your board members, it makes it much easier to create change. Most case studies have found that organizations who significantly invested in their own infrastructure have repeatedly noted that there's a difficulty in doing so without a shared agenda between your leadership team and your board. Finally, nonprofits need to begin to provide funders with better ways to measure their performance outside of just overhead ratios. In a Better Business Bureau survey, over 70% of individuals reported that they could not find sufficient information to assess a nonprofit or compare it to other similar organizations in its field. So creating even small steps towards collecting and disseminating data on outcomes can help an organization provide the basis for change. I think one great way to convey impact related items is your program service accomplishments section on your Form 990. So this is a free form section. You're able to write as much or as little as you want about your organization's programming during the year. So some organizations write one line. We often consider we often encourage you to spend a little bit more time writing a good overview of what your organization did during the year and the impacts that you had on the client. Be sure to add facts and figures to these sections to really drive home how your programs affect the community. Be sure this is updated every year and not just stagnant year over year. And another great way to get information out to donors is through your annual report. So if you don't issue an annual report, maybe it's a good time to think about the value that it can add for your organization. And if you already issue an annual report, make sure it's written in a way that really focuses on how you impact your client, and not just overhead costs and how you're lowering your costs.
Hey, Tyson, before we move on to the next myth, I just wanted to go back and make a comment on the percentages that you referred to, the 65% program that the Better Business Bureau likes to see and the 75% United Way. Those are just kind of their standards. Each nonprofit is going to be different. Those may be some percentages that you can strive for. However, it really depends on your organization. Organizations that are newer, that haven't been around as much, are going to have a higher percentage of management in general and fundraising, because you're still gearing up. You're still trying to raise funds. You're still trying to get some of those basic, just basic business operations in place. So if you are a younger organization, your management in general and fundraising percentage, your overhead is probably going to be a little bit higher. It also may vary year to year. In a year that you have a huge capital campaign, obviously your fundraising percentage is going to be higher then as well. So we just want to kind of keep that in mind. Like any other analytics or benchmarks, when you're comparing yourself to other organizations, you really need to be careful as to what that other organization does, where they're located, where they get their revenue, what kind of programming they do, how long they've been around. Because yes, you are all nonprofits. That's great, but you all do very different things. And so that's just something to keep in mind. And we also, when we are trying to allocate those expenses, we really want to have a reasonable basis. We don't want to just say, okay, Better Business Bureau says 65%. Let's just allocate 65% all the way over to program. That's really not how it should be. We really need to look at each of our activities and look at the resources that are being used for each of those. How much of your utilities, your staff is being utilized to offer this, program A and program B, and then also fundraising. So it's really something, like Tyson says, that does need to be evaluated on a nonprofit by nonprofit, but then also year over year, because things change, especially in these last few years with the pandemic. So just make sure that when you're figuring out what your allocation method is, that you kind of keep those items in mind.
That's a good point, Gary. Yeah, I appreciate your help there. So, okay, where was I here? Okay. That kind of leads into our myth number 3, which is not-for-profit organizations will lose their tax-exempt status if they make a profit. So this is very untrue. Nonprofits can and should probably make a profit most years. It's going to be really hard to run a nonprofit and to serve your clients without any cash inflow. Let's start by defining the term nonprofit, because I think that's kind of where some of the myth lies in just that terminology. So a nonprofit is a state and federal law concept. A nonprofit status may make an organization eligible for certain benefits, such as state sales tax exemption, property tax exemptions, and income tax exemptions. So really a non-for-profit is just a type of organization that has special exemptions in state and federal laws. It really has nothing to do with profits or losses at all. Make sure you don't look for the term profit or net income on your nonprofit financial statements. You won't find that terminology there. What you're going to look for is your change in net assets, which is a very similar term. You can find this at the bottom of your statement of activities. So if you're looking for that, that's where you can find it. A positive change in net assets will help your organization to build further cash reserves and ensure that your organization can weather an economic downturn. One thing to note here is, unlike a for-profit entity, not-for-profits do not distribute their profit to shareholders or owners. A nonprofit must reinvest all of its profits or increases in net assets back into the organization. So if you can't lose your not-for-profit status by making a profit, how can you lose your not-for-profit status? Well, here are some things that can jeopardize your exempt status. Private inurement is one of those, and this is when an organization's assets or income is spent to benefit an insider, typically a board member or a key employee. Lobbying is a big one, and there's a misconception here that you can't do any lobbying. You can do some, and lobbying is basically influencing the way that laws are written. And you can do some lobbying, but if you do too much, you may jeopardize your not-for-profit status. So lobbying includes contacting members of the government for the purpose of proposing or opposing certain legislation. It also includes urging the public to do so. So what lobbying doesn't include is more general communications that discuss only broad principles as opposed to a specific legislation. So not-for-profits can participate in lobbying, although the IRS does say that lobbying cannot be what they say a substantial part of the organization, or a not-for-profit can lose its tax-exempt status. So what is considered a substantial? The IRS does have two different ways to test if lobbying is substantial or not. And there have been a few rulings in tax court that point to around 3 to 5% of an organization's time being considered unsubstantial. So a substantial amount would be basically anything over 5% of the total time that you use in your organization. Make sure that lobbying, if this is something that you want to do and your organization is going to start to do, that you really read and understand the IRS rules on lobbying before you start. Another item that can jeopardize your exempt status is political activity. So not-for-profits are prohibited from supporting any candidate running for public office. This applies to the federal, the state, and the local levels. Another item is unrelated business income. So you can earn some from unrelated business activities, but too much could risk your exempt status. This is kind of a huge topic. Luckily, we're going to do a full hour on unrelated business income on July 13th. I think Carrie's going to be doing that webinar. So if this is a topic that affects your organization, be sure to sign up for that webinar. Another item that could jeopardize your status is not filing your 990 for 3 consecutive years. And this one is automatic. So if you don't file your 990 for 3 years, you automatically lose your exempt status. And the last one is not operating in accord with your stated exempt purpose. And this is kind of what's known as mission drift. So you start out with a mission, and as your organization grows, you move away from that a little bit, and you may start to do some other things. Well, if you stray too far from your initial mission, you could lose your tax exempt status. So that's something to keep in mind. Myth number 4. So not-for-profits must always have a balanced budget. This is kind of an interesting one, and I think this one's pretty widespread as well. And it can be a potentially harmful habit practiced by nonprofits. So board members and staff may be under the influence that nonprofits can't make any money. And they use that preconceived notion to create the budget and try to hit a zero amount at the end. There are certain times when a surplus budget, a deficit budget, and a break-even budget might make sense. So when should you adopt a surplus budget? So this is when your organization's leaders decide that its cash and other reserves are lower than what's ideal. An annual surplus can increase these cash reserves. Another reason why you may want to have a surplus budget is that your organization needs to pay down debt in the near future. So maybe you have a revolving line of credit or a mortgage due in the next few years, and you need a large lump sum to pay it off. Be sure, though, when you're making a surplus budget, that you use realistic revenue estimations to assure that you can hit these targeted surpluses. So when should you adopt a break-even budget? Well, this is almost never that realistic. A lot of the time, an organization will adjust what starts with a realistic expectation and then mold it into a break-even budget. And if your budget isn't really based in some reality, it's hard for it to be very useful at the end of the day. And when should you adopt a deficit budget? That's when your leadership decides that, okay, cash reserves are more than sufficient. What should we do with some of these reserves? So they may choose to make one-time purchases of fixed assets or other large expenditures, or give staff maybe one-time bonuses or non-permanent raises, those kind of things. Another good reason would be to invest back in your organization. This could be building a stronger fundraising department internally, or maybe increased efforts on the programming side of things. I think one reason that a lot of executives struggle and often create a break-even budget is that foundation grants and government contracts are typically break-even contracts. So you must prove that you spent exactly what was raised, but while grants and contracts are designed to break even, organizations are not. A healthy organization is going to require cash reserves, which means you must generate excess cash in at least some of the years that you operate, or you're no longer going to exist. So if your organization is one that always produces a break-even budget, take this year maybe to look at it, reconsider how these numbers, how you're getting to these numbers, and maybe design a budget that's more realistic. You might find that your budget's more useful and more accurate this way. And this leads kind of directly into our next myth, number 5, that nonprofits should not have excess cash. So a nonprofit, similar to any other organization, it's going to need excess cash and a healthy reserve to operate through economic downturns. The general rule you hear thrown out a lot is that you're going to need 3 to 6 months of cash reserve on hand. This is just a guideline, though. If your organization is in a position to be hit harder, maybe by economic issues, you may want more reserves on hand. Or let's say you think your revenue streams would be unaffected during hard times, you may choose to keep a little bit less cash on hand. But 3 to 6 months is a good general rule. But make sure you should have some kind of cash reserves, and it should be a priority for your organization to keep those on hand. So how do you successfully set aside enough cash for your reserves? Well, it starts with discipline. This usually starts within your budget and sticking to your budget. That's a huge part of a disciplined organization. It's going to take some structure. So having a strong financial team in place is a great start. Maybe you have internally a CFO or a high-level finance person, or maybe you rely more on your finance committee or your board for that kind of thing. Also, having sound policies in place for how much your reserve should be and where it should be stored are very helpful. And lastly is knowledge.
Oh, go ahead.
Do you have something, Carrie?
Yeah, I was just gonna say real quick that, we're talking about nonprofits should not have excess cash, which is totally true. However, you as a nonprofit have your exempt status for a certain purpose, and it is not to be a bank or an investment company. So it is not to hoard cash. So while it is definitely okay to have an excess amount of cash, there's no dollar limit that says you can't have, over a set dollar amount of cash. You should still be spending money on your programs and activities, because when you do file that 990 every year, the IRS wants to see what you're doing. And so if you are not spending money, you might not be actually meeting your exempt purpose. So while yes, it is true that there's not a limit for your cash, you need to make sure that you are continuing to use that cash to do what you're supposed to be doing, and not just become defunct, or not your activities become stagnant and you're just holding a bunch of cash. So there's kind of a two ways to look at it there. So just want to keep that in mind as well.
That's a good point, Carrie. It is kind of a balancing act, right? This kind of bleeds into, we'll start myth 6, which is using ratio analysis isn't important for nonprofits. So I think ratio analysis can be just as helpful for a not-for-profit as it is in the for-profit world. I think the best use of ratios can be on monthly dashboards presented to your board of directors. Best practices say that dashboards should be presented as a one-page document and should be organized with clear, concise information to make it easy for the board to review quickly and make decisions. Ratio analysis should only be part of an effective dashboard, though. You should also include other charts and figures that are relevant to your organization. Here are just a few ratios that we're going to talk about in the next slide that I think can be helpful to most nonprofits. But be aware that not all ratios are best used by all not-for-profits. So you need to take a careful look at each one of these ratios to determine if it's going to provide valuable information for your specific organization. We'll start by talking about liquidity ratios. So the first one is days of cash on hand. This measures the number of days in expenses that can be covered by your current cash balances. It's calculated by taking your total cash and divided by your total expenses, less depreciation, and then you divide by 365 to give you a daily number. Generally, higher numbers are better here, but like we talked about, holding too much cash does have its disadvantages. If you do use this ratio on your dashboard, I'd consider working with your board or finance committee to produce a target amount that you feel is comfortable in comparing your monthly amount to your agreed upon targeted amount. So an interesting note here is if you look at the last column listing the average value for different size not-for-profits, as the size of the organization goes up, cash on hand tends to go down a little bit. This is probably due to bigger organizations, having a lot more expenses, but probably having bigger investment portfolios as well. And as you can see from the formula, investments aren't factored into this ratio. Next ratio is months of spending. And this is similar to the days of cash on hand, but a little bit less extreme. The months of spending ratio takes receivables into consideration and assumes that they can be collected and sustained for operations. This may be a better ratio if your organization does have large amounts of pledge or accounts receivable during the year. Similar to the days on hand ratio, a large number indicates a more stable cash position. The next ratio is the savings indicator percentage. And this measures your net revenues that are retained by your organization as a percentage. It's calculated by taking revenue less expenses and dividing by your total expenses. This ratio should be evaluated based on the need of your organization. So if you plan on needing to pay down debt or make large fixed asset purchases in the near future, you may want this number to be really high. Conversely, if you're trying to ramp up programming and your program spending in the short term, you may expect this number to be lower as you use your funds to serve your clients. Like we talked about with the days of cash on hand ratio, I'd work to set an internal budgeted number each year based on your current situation. Next is contributions and grants. This measures the percentage of revenue received from contributions and grants, obviously. For some organizations, you may only have revenue from grants and contributions, so this probably wouldn't be the best ratio for you to use, but for organizations that have multiple types of revenue streams, this can be a good indication of how well your fundraising efforts are going. Next is the fundraising efficiency, and this indicates the amount of contributions raised for each dollar of fundraising amount spent. This can be calculated by taking your total contributions less government grants and dividing by your fundraising expenses. Higher values here are going to indicate greater efficiencies in fundraising. As you see in the last column, as an organization gets a little bit bigger, it becomes more efficient when it comes to raising funds, and that's kind of to be expected. Next are our spending ratios. The first one is program percentage, and generally we like to see this number a little bit higher. Like we talked about earlier, the larger number here means more money is being spent to help clients through programming. Next, management in general percentage. Generally, donors want to see this number low. Like we talked about earlier, this number should be zero, should not be zero, and shouldn't be reduced artificially to meet expectations either. And lastly is our fundraising percentage. And it's kind of the same story here. Donors want to see this number low, but be aware if you have contributions, you probably should have some fundraising expenses. Next, we'll look at benchmarking. And this is taking ratios that you've prepared and comparing them to other similar organizations. So the first step here is defining your peer group. And this should be between 5 and 10 organizations. But be aware that when doing comparisons, you should pick organizations that have the same size and are doing similar work as you are. This will give you more of an apples to apple comparison. For example, I really wouldn't want to compare, let's say, Fort Wayne Civic Theater, who's more of an arts organization, with a social services organization like Lutheran Social Services or maybe the Rescue Mission. So let's look at this example a little more closely. So they have a little bit more cash on hand than their peer group. Same with months of spending, and these two should generally move in the same direction. They have a little bit higher savings indicator than their peer group, so they're holding on to a little bit more cash. They have more in contribution percentage. And in fundraising efficiency, it looks like they may be a little less efficient than their peer group. This could be an area where this organization may want to focus in on. Let's move down to the spending ratio. So their program percentage is comparable to their peer group. Management in general is a little bit low, but if you look at the peer group and the range of peer group, this is in the last column here in this example, the lowest range is 3.9%. This is pretty low. So if I was doing this comparison, I may consider removing that organization from my peer group, as it seems to be a little bit unrealistic in this situation. And their fundraising is a little bit higher than their peer group. But again, look at the peer group range. They have one organization included that has a 0% in their fundraising. So I may also consider removing that from my peer group. Next, we'll talk about trend analysis. So this is, again, taking the ratios you've already completed and comparing them to your own past results now instead of a peer group. I personally like this a little bit better than benchmarking. I think it tells a little bit better story. And when you're comparing yourself to yourself, it's almost always more of an apples to apples comparison. But both benchmarking and trend analysis do have their place, and many organizations do use both. You can see from this example here that both liquidity and both the liquidity ratios are trending down in this example. So we talked about fundraising efficiency. Let's look at that a little bit here. We talked about it, that it may be an issue with this organization on the last slide. Remember, this is the amount of contributions raised per dollar spent in fundraising costs. And you can see here that they're actually trending in the right direction year over year. So I think in this instance, trend analysis is giving us better information. I personally also like to attach written explanations to trend analysis sheets, because there's often a good reason internally why certain ratios are moving one way or another way. And a written explanation can give the reader a more clear picture without having to ask questions during your meetings as to why different items are moving up or down. So overall, generally ratios can be a good tool for not-for-profit organizations, but only use ratios on your dashboard that are relevant to your specific organization and to your reader. Also, make sure you're benchmarking against organizations of a similar size that have a very similar purpose. Myth number 6 is that not-for-profits are owned by the board of directors. So this one is untrue. Nobody owns a not-for-profit, no one person. And this is the biggest difference between for-profits and not-for-profit organization. Is a for-profit is privately owned and can distribute earnings to employees or shareholders. Nonprofits do not have private owners and do not issue stock or pay dividends. So as we talked about earlier, nonprofits can earn a profit, but it just must ultimately be reinvested back into the organization. So can a not-for-profit be sold? No. Generally, when a not-for-profit decides to close or cease operations, the organization must settle all debts and distribute all remaining assets to another not-for-profit organization before it can ultimately be dissolved. So if you're not accountable to shareholders, who is a not-for-profit accountable to? Well, they're accountable to the general public. Most not-for-profits are created to provide a charitable purpose and for the good of the general public. They're accountable to state agencies. They must abide by certain regulations in the state that they operate. The big one is that they're accountable to the IRS, obviously. They must follow IRS guidelines to keep their not-for-profit or tax-exempt status. The biggest to remember is to file your 990 timely. Remember, if you don't file for 3 years, there's an automatic removal of your exemption. And the biggest group is probably your funders, your grantors, and your donors that you're going to be accountable to. And they may require you to complete grant applications and other reporting for certain grants. You're required to send thank you letters to your donors and funders, as well as making sure that their funding is used in the correct way as it's advised by the donor. So if your board doesn't own a not-for-profit, what exactly is your board doing? So they help determine the mission of the organization. They should help create the initial mission of the organization, but also review and adjust the mission annually if needed. They select and evaluate the chief executive officer. This is usually viewed as the most important role of your board. Ultimately, this executive director or top level person will report directly to the board. They ensure effective planning is taking place. This can be through reviewing and approving budgets and participating in strategic planning process of your organization. They also ensure that there are adequate financial resources available. This can be through reviewing monthly financial statements and ensuring that your organization has diverse revenue sources. Also, it could be just helping with fundraising through their personal and professional connections. And lastly, they enhance the organization's public standing. And this is done by championing the organization at events and other social gatherings throughout the local community. And our last myth, number 8, is that not-for-profits do not pay income taxes. This is our last myth. And a not-for-profit generally does not pay income taxes, but must file a 990 every year. The 990 is an informational return required by the IRS. Although a nonprofit will pay taxes on unrelated business income if you have any. So to be considered, let's talk about unrelated business income for a quick second. So to be considered unrelated business income, a revenue stream must meet the following 3 requirements. It must be carried on for the production of income from selling goods or services. It must be carried on regularly and not just a one-time or infrequent activity. And it must not be related to furthering the exempt purpose of the organization. Keep in mind, it doesn't matter what you do with the profits after they're generated. Deciding if a revenue stream will be unrelated business income is done solely on how the money is initially generated. So there's a misconception that if you use the unrelated income profits for programming that you don't need to pay taxes on it, and that's not true. A nonprofit usually does not pay property taxes as long as they have filed for an exemption on Form 136 with the accounting assessor. But keep in mind, you still need to file a property tax return. They're due May 16th this year, so that's coming up soon. If you haven't filed your property taxes, you may want to look into that. You may also notice that at the top of Form 104, there's an exemption box for filers with under $80,000 in personal property. Keep in mind that this doesn't apply for not-for-profit organizations and should not be checked if you're a not-for-profit. A 501c3 not-for-profit also does not pay sales tax on most purchases, as long as it'll be used for an exempt purpose. And as long as you have filed your sales tax exemption with the state via the NP20A. So that is the last myth I have for today. Carrie and Susan, you were looking at chat, right? Was there anything that we didn't cover today that was put in the chat?
I think there was a comment about low salaries. I think that's always an issue. You know, people think that nonprofits, and they do usually have lower salaries, and they shouldn't, but you know, that is kind of a myth that people think that they should. And I think that's, a difficult thing to overcome. One of the things that the IRS is always focusing on is the salaries that are paid to the CEOs of nonprofits. And I don't think that's a real issue in Fort Wayne, Indiana. But again, that is a very common myth about low salaries in nonprofits. I just want to make one comment about the property taxes. Not all nonprofits can be exempt from paying property taxes. There are specific uses of the property. It does have to be for a charitable purpose. And so I just want to throw that out there, that not all nonprofits can be exempt from property taxes. There are specific requirements. You can also receive partial exemptions for that. Same way with sales tax. There are very specific purchases that you can be exempt from sales tax. It's not just an overall, you are exempt from sales tax. There was a question about unrelated business income and actually losing money on the activity. No, so you need to track all of the unrelated business income, both the income and the expenses, but you start with your unrelated business income and then offset that by the related expenses. If you have a loss, then you probably do want to report that, though, so that way you can report that loss to the IRS. So that way, if you have future earnings, that can be offset. So there are some issues there with reporting that, but just make sure that you do track all of your unrelated business income. And having unrelated business income is okay. It's just you don't want to have a significant amount. I think that's all of the questions in the chat today. We just wanted to wrap up by, again, thanking you for taking time out of your day to attend our webinar today. Again, a copy of the slides will be mailed out to you, and a recording will be available on our website. You can see the link here on the screen right now. You can also see our upcoming webinars. You can go and register for any of those right now on our website. We are always looking for feedback. So if you have ideas, questions, future topics that you would really like to hear about, please let us know. We want to offer this information to you. We want to make sure that you are getting the knowledge, the education that you need for your organization. So if there's something that we can help you with, please contact us, whether it be for future topics, or if there's something else that we can do for your organizations. We are happy to help. All of our information is provided on our website, so any of us, feel free to contact us. Again, thanks Tyson for doing the webinar today, and hope you all have a great day. Thank you.